Have you heard of a short squeeze? Recently, it's something that happened on Wall Street, and it's made the news. But people often are confused by some of the terminology that is used on the street. A short squeeze is one of those terms that causes confusion for people. But it need not be so confusing. First, understand what selling short a stock means. Investors wishing to profit on the falling of stock prices can use short selling to accomplish this goal. In essence, short selling involves selling shares you don't own, which is what causes confusion. How can someone sell something they don't own? Short sellers contact their brokers and request shares of a stock to be shorted. The brokers will borrow those shares from another investor, often an institutional investor. The broker earns interest from the short seller for the privilege of this transaction, i.e., borrowing shares. Suppose XYZ stock is selling at $50 per share. An investor believes the price of XYZ will be lower within the next several days and requests to sell the stock short. The broker finds a willing lender, and the investor sells the stock at $50 to someone in the market for those shares. If the price falls to $25, the investor may buy back the shares, which would then be given back to the lender. The investor would have profited $25 per share. This is the positive scenario for the short-selling investor. However, a short squeeze occurs when there are large blocks of purchase of the stock. That causes the price to rapidly rise. If there are a lot of current short sellers, that causes them to panic and try to buy back the stock at whatever price they can, which is often well above the price they hope to sell. The increased buying pressure from these short sellers causes the price to rise even quicker. In our scenario, instead of buying back the stock at $65, the investor may be stuck buying at $100 or even more. Often the more short sellers there are in the market, the faster the price surges. Investors who use short selling as a strategy should always be concerned about the possibility of a short squeeze. Often, you can gauge whether one may happen by the amount of short interest in the stock, which you can find out from financial websites. As you can imagine, shorting a stock is a risky strategy and is not for the average investor. When there are a lot of investors selling short, the short interest in the stock is said to be high. Some institutional investors will buy up large blocks of that stock, created the frenzy buying.